Assalamu alaikum, everybody. I hope you guys are keeping safe. My name is Hina Nasir, and I'm working with ACCA Pakistan as Senior Marketing Manager. First of all, thank you very much for joining in today for Post-Budget Seminar 2020, hosted by ACCA. I would also like to thank PSX, Pakistan Stock Exchange, for joining as exclusive knowledge partner. So the budget has come out recently, and people have all kinds of various opinions on the budget. We have today gathered subject matter experts, thought leaders, and industry leaders here with us who will be sharing the insights on the budget and the impact on organizations, industries, and even on the individuals. Before we start with our first session, I'd like to encourage all of you to put your questions in the comment box, and we'll come back to your questions at the end of the session. I'd like to invite Sajjeed Aslam, who is head of ACCA Pakistan. He'll be sharing the impacts of Budget 2021 with us. Over to you, Sajjeed.
Thank you, Ina, and assalamu alaikum. I think it's always good to talk about that where we stand in terms of budget and how it's going to impact different businesses in a long run, in a short run, and I'm sure there are a lot of technical details where people will be coming and joining and talking about it. So what I'm going to do here, I'll just share with you based on one of a survey conducted by a very close friend. I'll share the names and details later. And what are the outcomes or what are the opinions we are seeing there? So first of all, welcome to the virtual post-budget seminar. And from here, I'll just share a little bit of finding based on the opinions which we can see being formed once the budget was announced. So the company Alpha Beta Co recently ran one survey with 150 business leaders just to evaluate what do Pakistan business leaders think about the budget. And how the outlook, what is the outlook they are talking about? So there was a very interesting question, like the budgetary impact on the overall business. The overall answer, if we see, there's people who are talking about positive, which is 13.1, and then people who are talking about it will have a negative impact on overall economy, still 27. But largely, people are very, very neutral in terms of the budget, and rightly so. This budget hasn't changed the existing framework significantly. There is a certain attempt where the relief is being provided, but at the same time, the budget may not have addressed some of the concerns the COVID has generated. So there was another question around the budgetary impact on overall business and industry. So significantly, if you see 60% business leaders are saying there is no impact, 25% almost saying it worse, and there are 14 or close to 15% which see it as a favorable impact, but significantly people are not seeing much impact of this budget. There was another question again, are measures taken in the budget enough to deal with the COVID-19 and revive the economy? The answer is significantly it fails to address that core issues, and that's one of our opinion which exists out there based on what the question was. Strategy over 12 months in light of the budget, where the people will be focusing. So significant focus is on a cost rationalization. There are few areas which are like 34% almost looking at the focus on the growth. And there's almost 7% who are talking about there is no change in the current one. But the cost rationalization came up as one of a key significant opinion out there. There was another question, how do you see economic and business performance over the next 12 months versus current period? So journal comment is that the economy to worsen off and the business to stay afloat. So people are seeing that the macroeconomic impact, it would be a negative on a macroeconomic impact, not necessarily only because of the budget, but the measures which people were anticipating or expecting could have been taken are not there, but the businesses significantly will stay afloat. If we look at the overall industry level comparison, so we see the energy supply is significantly talking about the cost rationalization. Then the technology and the transport and logistic is looking at the growth opportunities, where the manufacturing, trading, and the financial side is sitting somewhere in the between. So there's a different impact in terms of how the industries are looking at. So focus on the cost rationalization, growth opportunity, and no change in the strategy. So technology and transport significantly looking at growth, where manufacturing and trading, they are sitting somewhere in the middle, where the energy supply and all others are sitting more on a cost rationalization. Impact of changes in duties and taxes on the business, the majority have no impact there. Impact of COVID-19 on your business, I think there's a highly adverse. There are people who commented on that, almost 23%. 37% people were talking about, like, there is like not highly adverse, but still adverse. There are people who are talking about the highly favorable. So there's almost 6% people, the COVID has really positively impacted their business. And I'm sure we are talking about the technology-driven business. So this survey was conducted by Alpha Beta Core, and the giving a credit to Khurram Shehzad on that. It was an interesting scenario, good questions, and I think there's a very good outcome in terms of what people are thinking or what the business leaders are thinking there. So if I summarize the overall impact, so overall budget impact is seen as neutral. Whether budget is able to really address the question of revival of economy, so people are not highly confident on that. There are businesses who are seeing a positive growth going forward, and the budget is favorable for them. And there are, most of the industry are still seeing the budget as a neutral, and the COVID as a one of us adversely, the one of a key element which has adversely impacted their business. So this is how we see overall Pakistan in terms opinions in Pakistan in terms of the recent budget. So thank you very much for joining today. Over to you, Hina.
Thank you very much, Sajjeed, for that. Next in line, we have Mr. Haider Patel, who is partner tax EY for Rhodes, and he'll be sharing his thoughts on direct taxation. Over to you, sir.
Assalamu alaikum, everyone. This is Haider Patel. I've been assigned the task to talk about changes in the direct taxation side in the finance bill. So I'll take this job quickly through with you all. I'm not sure how many participants are logged in, because I can't see the number of participants, but I hope there's a people who are interested in going through all these changes that have been introduced. I'm trying to share the screen. Just a moment. Can you see the presentation? Hello?
Sir, the screen was visible for a second, but it's gone out.
Hello?
Ji, sir.
Yeah, can you hear me?
Yes, Mr.
Can you see the screen now?
No, it's not visible anymore. Can you please try again?
Okay. Yeah, I'll do that again. Now?
Not yet, sir. It's loading now. If you can give it just a minute. Yeah, it's on full screen. You can kick off. Thank you.
Okay. Okay, so should I proceed? Yeah, it's fine. Everybody can have a look at it.
Ji, sir, it's perfectly fine. Please proceed. Thank you.
So before I take, okay, so thank you very much, ACCA, for inviting me. Sajjeed Saab, CEO of ACCA, the entire management team, co-presenter Adnan Mufti, respected panelists for today, and all the participants who are logged in. Assalamu alaikum. Before I take you to the items of changes that have been brought about in the finance bill for taxes, let me tell you that expectations were quite a bit more about things to happen through this finance bill, especially on the tax broadening side. We were expecting more drastic measures to come in, but as you know, there was a change of guards in the middle of the year at the FBR when the chairman, Shahid, left the position and then was replaced by Nausheen Saeed, who was a seasoned bureaucrat and a grade 22 officer. She took over, and then since then, I think there have been a lot of administrative changes at the FBR and how you manage the field forces and things. But a bit of lesser focus has been seen on the broadening agenda, which was run very effectively in the last, I would say, 2019, or I would say a lot of discussion and a lot of input went into that. So we were expecting a lot of things, but obviously because of the COVID-19 issue, things slowed down everywhere, and it affected obviously FBR also and its tax collection and its plans for the future. So we didn't see much things in the finance bill which was introduced in the parliament recently on that side, but there have been some changes on the I would say implementation side of the law, and some changes here and there, not some a bit helpful and positive, some a bit I would say regressive. So as we start discussing one by one, I'll explain those to you. Let me tell you that there have been some material changes in the way when you file a return, how things are looked at, what are the authority of the tax authorities right now, and then how things will be looked at once you move forward. So the basic concept of the 2001 ordinance, when this was introduced and the 1979 old law was replaced, the entire scheme of things was based on self-assessment, that whatever you file as a return, it will be deemed to be accepted the day you file the return. And then, of course, they had the authority to do an audit and do an amendment of assessment going forward if they find that there's something wrong in your claims or anything, or if they do a routine audit, if they find evidence that there's something different than what should have been claimed, or there is some escape of any income, they can increase your estimate. They can estimate your increases and on the basis of evidence, and they can do a revised assessment. So that was how things were going on until now. What this finance bill now proposes is that your return of income will no more be treated as self-assessed on the day it is filed. Rather, it has now been a 6 months period has been given, between which the tax authorities can look at the return before it can attain finality. And in this 6 months, they can scrutinize for looking at arithmetical accuracy of your return, which I don't understand, because already most of the returns, 95% returns, electronically filed on the portal. So the chances of arithmetical accuracy being any mistake on the arithmetic side is not possible. If at all there will be an arithmetical mistake, that will be because of the part of the formulae on the portal and not on the part of the taxpayer. So that's not understandable. Then they say that they can look at incorrect claims, and then they can look at your claims for carry forward losses, deductible allowances, and tax credits. So the point is that these powers were already with them, and they have been looking at incorrect claims and losses and credits that you claim in your return. If you are a corporate entity or if you're an individual, they can always look at that. And there was another power. There is yet still a power in the section which says that your return will be self-assessed. It says that if there is anything which is floating on the face of the return where it looks like there is a mistake, they can at present also come back and say that look, we don't find your return accurate, and they can declare your return as invalid also. So in spite of that power still being there, now this relaxation of 6 months time that your return will not be deemed to be finalized, what it means really is that if you have a refund claim in your return at present, you can file a refund application immediately. And if your refund, suppose if it's not possible for FBR to give you back the refund, at least you can use that refund to pay your advance tax if it is due in the next quarter or something like that. You can utilize that refund over there, or at least try and make an attempt to get it utilized. But now for 6 months, for sure, your refunds or anything will not be claimed. So I would rather call this a regressive step, and I don't know what's the thinking behind this, but all these powers were already there, and this makes your fundamental theme of the change of law, which was brought in 2001. It was self-assessment backed by strong audit. So that theme seems to be distorted now as far as self-assessment is concerned. As we move forward, there have been changes in the assessment and audit procedures as well. We'll discuss that. So in the amendment of assessment powers, which the commissioner has, where they can amend your assessment, it means that what return you file, they can go and amend. So there was a provision that assessments can be amended on the basis of definite information acquired from an audit or otherwise. So what used to happen is that if tax authorities used to do your audit, and if they didn't find anything materially wrong in your claims or in your vouchers or in your expense claims or on your revenue side, then legally they could not make an addition. So in an audit proceeding, under an audit proceeding, because they had to have definite information. There were instances where they tried to disallow things on surmises and whims and fancies that we feel that, suppose they used to conclude that we feel that 15% of your expenses appear to be, say, your traveling expenses are more of a personal nature and rather than business nature, and they used to disallow that. So we as tax advisors or appealing on behalf of the clients, we used to say that please point out the particular payment that you have found out in the audit that you feel that this particular payment looks to be for personal use. And we used to challenge that, and if there was no evidence, then obviously you used to succeed in appeal. So this looks to be an attempt to to defeat that possibility that they used to lose the case. And perhaps the FBR is I thought about it a lot, that why they've done this, but I think they've tried to accommodate complacent attitude of the auditors that even if there's no definite evidence, and still if they feel that there is some element of expenses which are personal or maybe some other reason, then they're trying to make it possible for the auditors to disallow the expenses. But nevertheless, I don't think this amendment will have a material change in the way things are, and I think taxpayers will continue to fight out on the basis that there's no evidence, so you cannot do that. So these are changes which I feel were not necessitated. I don't know what has motivated the FBR to propose these changes, but I don't think they appear to be in some for some good reason. So they have to be looked at again by legislators now. If they sit on committees, I'm sure the standing committees will look at the finance bills, and people will make representations, the bars, the associations, and people will look at that. So if my recommendation, if there's any recommendation going from ACCA, is that at least this particular power or this amendment should be withdrawn. It will only create confusion rather than adding any value to the law. This is, I think, a new addition where the concept of agreed assessment has been brought in. It's not new. It has been there in the past. From the very beginning, we used to have audit panels which used to finalize assessments. Then we used to have the settlement commission concept in the past many years ago. But since the 2001 ordinance, we did not have any concept of and agreed assessment. So that concept has been brought in, that if there is a notice given to a taxpayer and he feels that the notice looks to be harsh, and then he feels that things need to be looked at by a larger forum, and he needs to propose a solution to the assessment, that okay, fine, I may not agree to 10 things that you are saying, but okay, I can agree to a few of them, or a part of them, and propose a solution to that. So the board is FBR is proposing to form an assessment oversight committee, which would comprise of the chief commissioner. The chief commissioner is the head of any zone, any zone in a city or in the corporate sector. There are different zones to deal with different types of cases. So there's the chief commissioner, the range commissioner, and then the additional commissioner who proposes the amendments in the assessments. So the three people, this committee has been formed, and they are empowered to look and examine the case of the assessment and what the proposal of settlement is. And if they agree to the settlement, or there is an agreement somewhere in between, and if the taxpayer is satisfied with the decision of AOC, he has to deposit the tax, and the assessment will be closed. But it's good that if there is no settlement reached, and the things can go back, and the commissioner can do the assessment as per law. And of course, the taxpayer will also have the right to contest the matter in appeals in the normal way if there is no settlement at this forum. So this is an alternate remedy, I would say, that to avoid harsh assessments, or where taxpayers feel that they are not being assessed well by the officer, then they can move an application to the AOC, and they can. But now let's see how things move forward, how these AOCs are formed, and what's the outcome of that. So law is in itself is one part of it, but the implementation is the other side. So let's see how it goes, but it's a good concept, I think. Alternate dispute resolution has always been there in all the laws, in the income tax law, in the sales tax law, in the excise law. And I think since 2018, the law was amended, and it was made, I would say, almost non-functional, because it was almost converted into a separate appellate forum rather than an alternate dispute resolution, because it said that if you come to this forum, you have to withdraw your appeals, or you don't file an appeal and then come. So you lose your right to file an appeal at the normal appellate forums. So it lost its alternate, I would say, characteristic of being an alternate remedy. So now they've heard everybody, and now they've come back and they've changed the entire law again, and it's become more taxpayer friendly now. And so now the taxpayer does not have to withdraw their normal course of appeal, and they will continue to contest the matter at appeals, and then come to the forum, find a solution here. If they get a solution, then they can withdraw the appeal before the appellate forums, and there's a time frame for that within 60 days they have to complete that proceeding. And one thing is that the what has been changed than before was that before this was a 3-member committee, and now the committee would comprise of chief commissioner having jurisdiction of the case, and 2 persons from a panel notified by the FBR. Normally the panel consists of somebody from the industry side and from the professional side, like a chartered accountant or a lawyer or somebody from there. So now the committee has to decide the dispute through consensus rather than a majority. In the past, it used to be that if 2 members agreed to a proposal of settlement and the third member didn't, the decision used to go with the majority. But now the wording is that it has to be a consensus, which means that if there is no consensus, then the committee will conclude without coming out with a decision. So there is a possibility that many decisions may not come because of this thing. So my suggestion would be that it has to be still the majority which should go, and the decision should be based on majority and not on consensus, because consensus development would be a difficult task, especially with the tax commissioner or the chief commissioner sitting there. So it may become difficult to operate ADRC with this provision. Otherwise, I think the changes are fine. The law has become much more taxpayer friendly and now creates an alternate situation for the taxpayer. So I think looks good so far, except for this one thing that I just pointed out. Then on the broadening side, of course, I would say the FBR at the moment had links with NADRA to get information, but now it has been brought in the law that they'll have powers to get real-time access of information and database of various organizations and they are like FIA, Bureau of Immigration, Overseas Employment, NADRA, provincial development authorities, electricity and gas discos and gas transmission companies, etc., etc. So the attempt is to like create a database for each taxpayer, and now I think they have got real time access to all these databases. So if you see this amendment with another amendment which has been brought in the law, and I'll take you there, and then we'll come back quickly. That's about this taxpayer profile. We have a taxpayer profile existingly also in our tax return, but it's not. There are some fields which are which the taxpayer fills out, like its contacts, its email addresses, and things like that. But now the law has actually brought in a whole section which requires the taxpayer to create a profile of their own. The existing taxpayers who are in business and who are non-profit organizations, trusts, and the new people, of course, who will be now becoming taxpayers, all of them would be required to do. So at the moment, the focus is on business and things like that, and trusts and institutions who the existing taxpayers are required to mandatorily, go and update their tax profile within the next. I think there's a time frame given for that. So what they have to update is their bank account, their utility connections, business premises, manufacturing facilities. Most of these requirements are at present also required if you're registered for sales tax purposes. The manufacturing facilities, storage, retail outlets, everything was required. Utility connections details were required. Bank account details were required. What type of business you are. So now it has been also formalized on the income tax side that every taxpayer has to have a tax profile. And the deadline is that in case of a person registered before 30th September 2020, it's before 31st December, and anybody who comes and registers after that will have to do that within 90 days of registration. So it's a positive change. There is a penalty also now for not, filling your taxpayer profile, and it also says that if your profile will not be complete, then you will not be regarded as an active taxpayer, and there are repercussions for not being on the active taxpayer list because your withholding rates and etc. Many things, they really double up, and there's a lot of cost to it if you're not on the ATL. So it's a welcome proposition. So going back to the real-time mechanism that I talked, that they have now access to information. I think this is the linkage that they are trying to create this profile from the taxpayers, and then connect that profile probably to all these real-time access. Real-time access information from all these sources. So your profile will then get populated by the data coming from these sources. So it looks at the moment very, very green, and it looks like if all this happens, really the FBR will have a very fantastic sort of data of people traveling around, data from immigration, overseas employment, if somebody's got employed abroad, data from NADRA, any change in their status in all of that, and then your electricity connections, and your billing details, what are you consuming, your gas connections, all of that, and etc. So there'll be a lot of plethora of information, and if this is connected, if all the text profiles are connected to this real-time access information, a lot can be done to broaden the tax base. So the law part has been taken care of now here with the text profile, with the real-time access. All has to be seen as the implementation part, which has always been a challenge in the broadening side. So let's hope and pray that things are moving in the right direction on that side, and these things will help the tax authorities to move in the right direction. Some discussion about some changes in the deductions allowed at the moment. Transactions where you don't do any transaction through banking channel, if there's a head of account where the expenditure exceeds 50,000 rupees, and if you don't do transaction through banking channel, then the expense is not allowed to you. That threshold of 50,000 was too low, and it's been there for a number of years. It's been now increased to a minimum of 250,000. A single transaction exemption from the above law was provided at 10,000. It's now 25,000. Salary was 15,000, and now it's brought up to 25,000. I think it's a good move because even the minimum wage is now about 18,000 rupees. So 25,000 salary, you can pay up to 25,000 in cash. I think that's reasonable, keeping in mind that the salary basic exemption is 400,000 rupees a year. So 25,000 monthly salary means 300,000 a year. So I think it's fair if you allow that by cash, because there's no tax involved from such salaries. There's also a proposal to disallow deductions claimed on account of utility bills in certain conditions, but they'll be prescribed later by the FBR. That in what cases this law will apply, it's not clear now, but there is a proposal definitely to disallow utility expenses in some cases. We'll have to wait and see what type of cases the FBR says where this disallowance could come in. And then there is this proposal that industrial undertakings who make sales to persons who are required to be registered, but they are not registered under the sales tax. And if you make a sale to such a person exceeding 100 million per person, then suppose if you have one or two such customers, in the entire sale that you make to that person, and if the per person sales exceed 100 million, then your expenses will be disallowed in the proportion of the turnover of sales to such persons above 100 million and the total turnover for the year. So there's a cap on such disallowance that it will not exceed 20%. Conceptually, I think that this is 100 million rupees sale to a person is quite a big number. It's about 10 crore rupees sale. So one can argue that you should not be doing business with such a person who's got such a large transaction and yet they are not registered. But there will be instances where the implementation will become difficult for the seller. I'll give you an example. It's the iron industry. Companies who sell steel bars. So if somebody is doing a construction of their house or an office or something, and they are not registered, or they are not, so they are not registered because they are not into the business of buying steel and selling. But if their purchases exceed 100 million rupees for a construction project, that's not a figure which can not be reached. So for such industries and for such sellers, this could become a challenge for their disallowance of expenses. So I think exceptions need to be created here, that if the goods are it says that for persons who are not required to be registered, but then it may become difficult sometimes to contest that. So whilst the concept is there, but I think the most foremost thing is that it is the duty of the FBR to first try and identify people who are required to be registered and get them registered, and they have the powers to compulsory register also. So if they are not able to get them registered, this burden is being passed on to the industry, that they should not do business with them. I think this is a bit harsh and a bit unfair. So this has to be looked into, and if not totally taken out, then at least it has to be made a bit mild for certain sectors who might be hit by this provision. Depreciation deduction. In the past, you used to get a deduction for your business assets in the year when full depreciation in the year of acquisition, and no depreciation in the year of disposal. Now the proposal is that you'll get 50% depreciation in the year of addition and 50% in the year of disposal. So these are minor changes, but there may be impact, because when you get a full year depreciation, even if you have bought an asset on the last day, it's substantially a good claim, but it's only a timing difference basically what's happening. So these are minor tweaking things. I don't know why FBR gets into proposing these things, because somehow they try and minimize the amount of claims to increase your tax liabilities. But then these are timing differences. This is not an absolute disallowance. So I don't think there was a need for that. But nevertheless, it's a conceptual change over the years. The impact will fizzle out. Then credit on donations, this has now been restricted. At present, if you are a individual or an AOP, you get a credit of 30%. If you can get a credit up to 30% of your taxable income if you give donations and claim credits for that. And if you're a company, you get a credit of 20% on the donations that you give for charitable purposes. Now it says that if you're giving a charity to an association, to a trust or somebody which is your associate, then this percentage of credit will be reduced to 15 and 10%. So maybe the FBR has found out some misuse or something, that companies are parking their profits in these trusts or something like that. I don't know, but I fail to see any such example around me but there must be some study, based on that they have make this effective. So if you give to your associates, you are entitled to a lesser amount of tax credit against your income, against your taxes, and if you give to a non-associate, then obviously you're entitled to the full amounts of credits that are presently in the law. So this is the proposal. Deductions against property, very quickly, at the moment you could not claim a deduction if your annual rent income was below 4 million rupees. But now this option has been opened to all taxpayers, and everybody can opt for either being taxed on the gross amount at a reduced rate, or offer their net income out of property income, and offer it for tax at the normal tax rates. So this is an option which is now open to all individuals and OPs, instead of just the people who were earning a higher amount of rent in the past. The rent collection charges, this is an absolute allowance sort of a reduction, which was 6% of the gross amount of rent. It has now been proposed to be reduced to 2%. I don't know why. 2% seems to be a low rate, but I'm not sure if there is a market research behind that, what's the normal amount of collection charge that brokers do for collecting rents. Maybe it's on that basis, I'm not sure. But certainly it will be a dip in your claim of expenses against your property income. Then there's a proposal to restrict foreign interest payments on foreign loans. And this payment, although the heading of the law says that from associates, but it applies to all borrowings, whether it is from within the group company or it is from a third party. Even if you're an industry and you're borrowing from financial institutions, this will apply to them. And the proposal is to disallow foreign interest in excess of 15% of taxable income before depreciation, amortization, and foreign profit deduction, which will be allowed to a foreign controlled resident company. Foreign controlled resident company has been defined in the law to mean a company which is 50% or more owned by a foreign entity abroad, where the shareholding is owned by foreign shareholders. So the restriction will not apply if the total foreign interest as a reduction is less than 10 million rupees a year. So it's there for large interest claiming companies, and if there's any excess claim which is disallowed, then it will be allowed to be carried forward for 3 tax years for claim in future years. But after 3 years, if you cannot absorb that, then it will be a sunk cost. So I don't think foreign companies who are coming into Pakistan and their models are based on loans or debts acquired from their home countries, this won't be welcome with them. They won't look at it positively. For foreign investment, obviously this will be a setback, but because there was already a restriction on the concept of thin capitalization, that if you borrow from a group company and your debt to equity ratio is more than 3 times of your equity, if your debt is more than 3 times your equity, then there was already a provision of Section 106 which used to disallow interest given to the associate companies themselves, but that provision did not apply to third-party loans. Now, this provision is proposed to apply to both borrowings from within the group and borrowings from third parties, and without any threshold of debt to equity. So seems to be a harsher provision than the previous one, but OECD recommendations are also there that you must do this. So Pakistan is, I think, following that model and trying to restrict such deductions. They're trying to encourage. The other side of this is that you encourage more equity investments, but then equity investments are always difficult to attract, and people are more comfortable in more debt financed projects because they don't want to stick on their equity for a very long time here. So has to be seen how future investments will shape up and how people will look at foreign investors will look at this provision. Capital gain, I'll run very quickly because this came a few months back when the government announced the package for construction industry. Broadly, the progress reduction in the amount of gain which is taxed. I've given the new table. It goes up to 100% for exceeding 4 years. If you held a property for more than 4 years, then it's not taxable at all. And if it's less than the holding period, then the tax rates of 5, 10, 15%, they would apply to gains in this proportion, where so much of your gain will be taxed. So moving forward, minimum tax, which generally applies to all taxpayers if you have losses for any reason, it used to apply to only resident companies till now. Now the proposal is that it will apply to non-resident companies having a permanent establishment in Pakistan as well. I think for so many years, if this proposal was not there, there was a reason why it was not there, and it was very well understood. But now, having understood that reason, still the FBR has done this proposal, and the reason is that the foreign investments, foreign branches in Pakistan, foreign businesses, they are covered mostly by double tax treaties. These investments mostly come from countries where Pakistan has got double taxation agreements, and those double taxation agreements, all of them talk about only taxing of profits. So if there are no profits and if there are losses, the treaties don't allow you to tax the non-resident person. So I don't think this proposal will go well, and it will be challenged, because the non-resident branches in Pakistan, they will challenge the tax authorities on the basis that they are covered under the double tax treaty of a particular country, where you can only tax profits and you cannot charge a tax if I'm in a loss for whatever reason. So I think this is a futile exercise in 90% cases. There'll be hardly any companies in Pakistan which would be coming from non-treaty countries. Pakistan has got about 67 or 68 tax treaties with various countries, and most of the places from where Pakistan attracts investments, they are covered by treaties. So this is not going to work well. I don't know why this proposal has been brought in the first place. This has to be reconsidered. For non-profit organizations, I'll quickly just highlight the most important things. To qualify as a non-profit organization and to be tax-free, you get 100% tax credit subject to fulfillment of certain conditions. Now they've added another condition that every such company will file a statement of voluntary contribution and donation received, and the details of who has donated in all in the immediate preceding year, whatever donations you have received, you have to give the detail that who were your donors. Now this will be a big challenge for many large philanthropic organizations, because many donations are no name basis. So this will be a challenge for them, how they'll manage this, and how they'll explain the FBR that so much a large chunk of money has been given by people who have not disclosed their names. Like if you go to Indus Hospital, you'll find boxes over there, and people are just asked to deposit money in those boxes, or you are required to transfer money. You can do an easy pesa transfer or anything also. So it will be a task for these organizations to gather all this data, that who has donated this money to me, and provide that information to the FBR. So it's a bit of hassle, and we'll have to see how things work. Then there is a concept that if you are having surplus funds, that means that if you haven't spent 75% of your donation receipts for the year, then you are the surplus fund is about 25%. If there's any surplus fund left, that's taxed at 10%. And then out of this surplus fund, if you have got restricted funds donated by donors for specific purposes, then they are allowed to be excluded from this surplus fund calculation. Now, one thing that they have done is that when you calculate your surplus funds, here again, they have said that those restricted funds which have been received from associated donors, they will not form part of the exclusions, which means that exclusions will only be for third-party donated restricted funds. They'll be excluded from the calculation of surplus funds. So it's a bit tricky to understand, but I think this is what the theme is, that they want to suppress donations from associated parties, that companies donating to their trusts. There must be some background. We saw a proposal on the credit side as well, on the tax credit side as well. So the same theme is running here. Clause 66 is a famous clause where income has been exemptions have been granted to various official funds, non-profit organizations, trusts, welfare organizations. This list has now been broken into two parts, where the first part mostly comprises of officially funds like the Prime Minister's Fund or the Chief Minister's Fund for some relief and things like that, and some very renowned organizations. And the second part comprises of mostly the non-profit organizations like AD Trust, the Indus Hospital, SIUT, and all the names are there. Now the exemption of tax which is provided under 66, this used to be, without any condition. Now all those entities which are appearing in the second list, they now have to, also fulfill the condition under section 100C. So in a way, this exemption is now subject to fulfillment of conditions, which requires that, they file a return, they file their due withholding statements, they are properly withholding taxes, then they file a statement of voluntary contribution. So all those things have become mandatory for these non-profit organizations as well. So effectively, the benefit of 66 actually goes away as I look at it, and all these organizations which are listed here, they go back to section 100C, which is that if you are a non-profit organization, if you are a welfare organization, a trust, you have to fulfill all the conditions, and if the tax authorities will examine and they see that you fulfilled everything, then only you will be eligible to a zero tax situation. So things will become difficult for them operationally, but this is what has been suggested. We talked about taxpayer profile earlier, so I'll skip that again. Final tax regime has been, excluded last year, by and largely last year, and some of the remaining were removed this year. And now whatever taxes withheld at source, be it from imports, be it from supplies, they're all treated as minimum tax. So the bill now seeks that, there was a statement under section 115.4, which we used to call the final taxation statement. And the benefit was that you used to declare your gross turnover and the tax which was withheld at source, and you say, this is my return. I don't need to file my audited accounts or any sort of profit and loss account. And this is the basis. On a gross basis, I'll be taxed. Now, this statement has been taken away completely, and now all taxpayers will have to file normal returns. And the board has been prescribed to, identify different types of returns for different categories of people. But the theme is that now everybody has to consequentially file their profit and loss account and support them with, books of accounts and everything. So everybody has to now compare the minimum tax withheld with, the actual tax liability, and the actual tax liability can be scrutinized by the tax authorities, which was not the case in the past. So this is a step, one more step towards documentation and, proper filing of your income, and going towards the actual income-based taxation system. Statement number 65 was at this moment biannual.
Sorry, sir.
Sorry.
We are a little short on the time. If you can kindly wind up in a couple of minutes.
Okay, I'll just go then through the important slides only. I'll skip a few.
Thank you very much.
Just emphasizing here that another regressive step has been proposed, that if you want to file an appeal at the second stage, which is the Appellate Tribunal, which means that if you lose the first stage of appeal at Commissioner Appeal stage, you are now required to mandatorily pay tax up to 10% of the tax upheld by the Commissioner Appeals. Now, this is a very regressive step, and you cannot take away a right of appeal from a taxpayer on the basis that whatever tax you have imposed, he has to at least pay 10%. And sometimes there were frivolous assessments where huge demands are created against taxpayers, and this becomes difficult. This was tried to be done in the past many years ago, and it was removed then on the popular demand of the bar and the fraternity and the taxpayers. I strongly feel this should not be part of the Finance Act. It should go out. This proposal should not be accepted by the legislature, because this is against the fundamental rights of the taxpayer, that they have a right to go and file an appeal. I'll skip that. Fundamental change in taxation of imports and at import stage. Now a 12th schedule has been introduced, where items have been categorized in part 1, 2, and 3 of the schedule. Very quickly, part 1 and 2 lists many items on a HS code basis, which have been said to be capital goods and raw material. So the tax collected at import stage would be 1% and 2%, which fall for goods under part 1 and 2, and this will not be the minimum tax for industrial undertakings who are importing these goods for their own consumption, for their own production. So which means that this is fully adjustable, and you will pay tax according to your own bottom line taxation basis. The tax collected under part 3, where the tax rate is 5.5%, that's a minimum tax. So practical difficulties are coming out as we now discuss it, and I've been discussing this at the Pakistan Business Council. There's a lot of hue and cry over by the industries that there are very few goods which have been listed in Part 1 and 2, and even in Part 3 there's a lot of category of goods which are missing. So representations are being made to the FBR. So there's going to be a lot of difficulty coming out here if things are not sorted out by the FBR before the Finance Act. But incidentally, the board has also been given the power under the draft law that they can also add items to the schedule. So that's a good thing. Actually, if somebody points out, it can be done. But I'm looking at a lot of hassle for industries again to go towards this new regime. And the tough part is that the power to give exemption, which is now there, that has been completely proposed to be withdrawn. So if somebody is, under a loss situation because of depreciation or something, and they are importing raw material, they'll have to mandatorily pay 2% tax, even if they are come under Part 2, and then claim a refund later. So I think complete abolition of exemption provision was not the solution. It had the exemptions provision should continue to be there to look at hardship cases and allow exemptions from any deduction. Then some minor changes here, not very material. 152, yes, the 3% reduced reduction for service sector was not there for non-resident service providers. It has been brought in, with just one exception, that engineering services have been left out, both for residents and non-residents, which was always there at 3%. Now engineering service sector companies will suffer 8%. What's the logic behind that? We don't know, but I think there are that it should be restored. So overall, a good addition for non-residents who are deprived of the reduced 3% rate on service sector under Section 23. So that's come there. There was a hardship in case of foreign payments of royalties, fees for technical services, insurance, reinsurance payments. That under the 10th schedule, if you are not paying to a person who is on the active taxpayer list, then the rate of withholding doubles. Now, non-residents who are not based in Pakistan, they are not supposed to file anything here. It was a hardship case for them, for the payers actually, that if the withholding rate was 10%, it used to be doubled at 20 for people who are not registered in Pakistan. So that hardship has been taken care of, and now I think things will be better off for people getting services and from non-resident service providers who are not in Pakistan.
Thank you, Haider. I'm really sorry.
Remaining things we can cover up in question or session if there are any specific questions. Thank you so much. Thank you, and for taking excess time.
It's okay. Thank you very much once again, Mr. Haider. There are several questions that have been popping up in the conversation box, but we have dedicated 20 minutes at the end of the seminar for questions and answers, and that's where we are going to pick up the questions. Thank you once again. And now I'd like to invite Mr. Adnan Mufti, who is a partner at Shekha Mufti, chartered accountant, and he'll be speaking about indirect taxation. Over to you, sir. So could you please share your screen? And you're on mute, I can't hear you. You'll have to unmute that button.
Yes.
Ji, sir, I can hear you now.
Am I audible?
Ji, sir, you are audible.
And can you see my file?
Not yet. If you can share your screen one more time. Yeah, it's uploading now. Ji, it's on full screen mode. It's perfectly visible and you're audible. Please proceed.
Bismillahirrahmanirrahim. Assalamu alaikum everyone, and thank you ACCA for inviting me to the seminar and affording me an opportunity to basically express my views on the amendments that have been brought under the indirect tax laws. There are a couple of amendments that have already been explained by my friend Haider, so I'll basically skip them to basically give you an overview of what has basically been done on the indirect tax side. More or less, it is the same what Haider has explained, yet there was an expectation that keeping this corona problem around, we will have some sort of a reduction in the rate of GST and especially there was some demand that food items mm, should be brought down. The rate of tax on food items should be brought down to 5%, but that wasn't being done. Then there was an expectation and a demand, of course, from the industry, and my friend from Karachi Chamber will basically endorse that there was a demand to zero rate the export oriented sectors, but that wasn't being done. So one wonders that with the increased revenue target of around 27% from the existing one, how the FBR is going to basically consolidate its target or revenues in the year to come. But basically, that we will see. So basically, this is I'll take you to yes. So coming up with the first amendment, the definition in section 21(2) of the Sales Tax Act has been amended to basically remove. There is a clarificatory sort of an amendment whereby the blocking of taxpayers, which was a discretionary powers with the commissioner, has been its reference has been removed from the definition. So this is the right step, I think. One more thing, that basically a few years back, the law was couched in such a way that that more and more harmony was basically brought in between the income tax and the sales tax law. And at that particular time, it was brought in the law that anyone who is who does not file his statement under section 165 of the income tax ordinance will also be classified as a non-active taxpayer. And of course, as explained by Haider, there are multiple repercussions for being inactive. So basically, this has been fortified this time as well. Value of supply, the section 246 has been changed. The first amendment is basically a clarificatory, because the reference of WAPDA in case of electricity supply was perhaps omitted last year. So this has been done with a retrospective effect from July 2019. Another thing which is welcoming is that the government has tried to bring the second-hand market uh, uh, into the text net, and for this purpose they have basically come up with a facilitative move whereby the second hand dealers of used vehicles will be asked to pay only the marginal tax, the tax on the difference between their purchase price and the price at which they purchase their vehicle, the vehicle, and the price that they on at which they sell. So it is the tax will be on the marginal side, not on the gross sales value. That is a welcoming step, though we understand that it's an alien concept to the very scheme of the act. However, from the broadening of tax base perspective, it's a good step, and it should also be what we understand, this sort of an this sort of an scheme should also be offered to all the uh, second-hand market. For example, second-hand market, there are vast second-hand market for furniture, for equipment, uh, etc., etc. So I think uh, for all of them, this scheme should be made available. Then there was a confusion, I would say, because the enabling section, that is that we call under the legal terms the charging section. It was then the reference of withholding tax on services was missing in the charging section. That has been brought. So now it is clear that all services originating from Islamabad Capital Territory will undergo withholding. Then, of course, a major change in 11th schedule has been made, whereby a person registered but not filing returns will not be basically classified as an active taxpayer. Rather, he will be considered at par with an unregistered payer, and therefore he will basically suffer whole of the sales tax uh, when he supplies to government authorities or government institutions, and while he supplies to companies, he will attract withholding tax at 5% of his gross value instead of 1.1/5 or 1/10 that was the previous case. So basically, these are the steps whereby uh, the non-active taxpayers are being pushed to ensure their compliances, their statutory compliances, in order to remain, in order to keep enjoying the reduced rate of taxes and to enjoy other benefits available in the law. Very strange and a very significant, I would say, amendment that has been brought is a restriction on the wastage of input goods. If you, I would say, uh, if you look at the budget speech made by the industries minister on the floor of the National Assembly and the amendment that has been brought in the law, it makes things very clear that basically the government is concerned on various on reported malpractices where the production is suppressed under the garb of wastage. Consequently, the sale is suppressed and ultimately low sales tax is paid to the government. So basically, and on the other hand, the taxpayer claims entire input tax on such wastage. So while we understand that there have been some cases, there have been some genuine reporting on this account as well, but we are unclear how the provision will be implemented, because whether input tax will be disallowed on the wastage, the provision doesn't say this. The provision says, although it is misplaced under section 7, but going by the language, it says that wastage, the ultimate, if you read the language that has been brought in, it means that wastage will be treated as good units, the prescribed wastage, and added back to the production. But we understand the provision is misfit in the overall scheme, because there are no enabling amendments in section 3 of the act whereby production can be uh, added back to the inventory and sales tax may be demanded in the case of excise. This identical amendment has been brought in excise as well, but we understand that since excise is on production, it may sail through in the excise law, but this provision is alien and incomplete to the best of my knowledge in the sales tax law. The corresponding amendments still needs to be made in the sales tax. Then again, this area has been, I believe that this is basically 124A of the income tax ordinance that has been brought in the sales tax and the excise law, whereby assessing officer will be under legal obligation to follow a question of law decided by the tribunal or the high court in favor of the taxpayer. So that basically this will basically reduce the litigation, and the same issue will not keep uh, cropping up in subsequent years until unless it is finally reversed by the High Court or the Supreme Court. So this is basically a good step and will reduce the litigation. Another issue, yes, CNIC number on the face of the invoice. There are the two things that have been done. Number one is that retailers have been given an additional benefit whereby their sales limit without demand of CNIC has been enhanced from 50,000 to 100,000. However, this needs to be noted by all of us that basically this particular sort of an exemption or concession, I would say, was basically only restricted to retailers and not by any other one. So basically, that means that all sales, suppliers of manufacturers, importers, wholesaler, distributors, etc., will entail production of CNICs without any monetary threshold. Uh, that is the first part. The second part is that presently the CNIC, the law says that only if you sell taxable goods to an unregistered buyer, the seller should have the CNIC of such buyer. Now, otherwise, the proportionate input tax will be disallowed. Now, this scope of disallowance has also been extended to the services as well. So basically, we can see in the coming months that input tax on services that was initially paid to the provincial tax authorities or to FBR for services rendered under the Islamabad Capital Territory framework will also be disputed because of want of CNIC of the unregistered. So basically, this is a very significant amendment, and I think that genuine taxpayers will basically will be, it will go to the disadvantage of the compliance sector. E-audit, yes, I think Heather has already discussed this. The concept of e-audit has been introduced, where you see, if you look at the overall scheme and envisaged under Section 25 of the Sales Tax Act, it says that whereas the commissioner has the powers to select the audit, where the conduct of audit is the job of the subordinate tax authorities, uh, whereas in the provision that has now been proposed, it says that the e-audit will only be conducted by the commissioner. So basically, we understand that if we see the overall intent of the law in section 38, 56, 25, it says that basically we are moving towards e-audit. However, since the powers and the rules have not been framed, we can see disputes arising on this account as well. Returns, section 26 has been amended. A large number of taxpayers file returns only with essential information. You see, there are a lot of annexures associated with the return. Some some taxpayers only file annexure C, some file annexure A, and they file largely those taxpayers who do not file, do not prefer to file the entire return for one reason or the other. They only file annexure C, and then it is considered as a tax return filed on their by them, or on their behalf. Now the law says that the taxpayer should file complete return. So basically, if the annexures are not fulfilled, are not filled properly, it will basically attract penal action under section 33, though the penalty part has not been quantified as well. So there is a there is a it is essential that now taxpayers take these return factor very seriously and come up with complete returns. In section 33, yes, there are certain penalties that have been introduced. First of all, that presently business premises can only be sealed after 6 months of violation if you basically do not integrate uh, your system with that of the FBRs. So basically, at the moment, retailers are only allowed and they are entitled to do so. And with a reduced rate, we'll see this aspect in the later slides. Now onwards, business premises may be sealed only after 2 months of non-compliance. So basically, the period of 6 months, which was previously there in the law, has been reduced to 2 months. So non-integration with FBR's database for 2 months will basically entail a sealing of business premises till the integration requirement is complied with. Again, in newly inserted section 56AB, the penalty for non-provision of real-time access of information will be 25,000 on first default and 50,000 on subsequent default. Appeals, appeal fee has been enhanced, and again a section has been inserted whereby the commission appeals has been barred from admitting additional information at appeal stage if he satisfied that the taxpayer the taxpayer who is producing an additional evidence was not basically genuinely not presented at the original stage or the assessment stage by the taxpayer. Otherwise, he will not entertain such evidence. Alternate dispute resolution, Heather has covered, so I'll basically skip this. Real-time information, Heather has also covered this, section 56AB. One thing that I want to basically highlight, that you see, we see that FBR is now basically will have real-time access to all these information, NADRA information, information by FIA, employment, land record, etc., etc., etc. But you see, the major factor which basically will determine the success or failure of this particular provision or this particular exercise will remain the FBR's existing capability or the capability in coming times. Because you see, at the moment, FBR has, for example, if you look at the number of industrial and commercial utility consumers, it is more than 3.5 million, whereas only few thousand uh, industrial or gas, industrial or commercial utility connection holders, they file returns. So the data of utility companies to start with is already with the FBR, and what I mean that data has not been effectively utilized by the FBR as of now. So uh, we can understand that these type of additional accesses to records will not basically change the overall revenue picture unless and until FBR improves its enforcement capability. Supplies to unregistered person, another very important area. Uh, Last year in December, the government came up with basically an ordinance whereby manufacturers were barred from supplying taxable goods to unregistered person beyond annual threshold of 100 million and monthly limit of 10 million. Now this scope has been extended to every taxpayer. You see, every taxpayer, be it a manufacturer, be it an importer, be it a distributor or retailer, he cannot basically supply to unregistered person beyond this particular threshold. So we understand this provision is unjustified and unwarranted because the foremost thing is that on all transactions with unregistered people, there is a there is an extra sales tax. There is a further sales tax of 3%. So there is a higher withholding rate from supply for unregistered person. Then there is a scheme of third schedule items whereby manufacturers are obliged to discharge the entire liability of the supply chain on those particular products. So in the wake of all these things, this particular provision seems illogical. Of course, it is against the principle of natural justice because no one should be condemned for the act of another person. You see, my buyer is an unregistered person. He is not getting himself registered. He is not sharing his information with me. He is not producing a CNIC with me, etc., etc. So I should not be basically penalized for all of his acts. So I believe that as a result of these measures, cost to ultimate consumer will be escalated because the unregistered person will prefer to remain outside of the tax net by passing the burden of indirect tax on consumers and, of course, avoiding his personal income tax liability. These measures may also persuade taxpayers for adopting creative accounting. And of course, last but not the least, the door of litigation will remain open because these types of amendments may be challenged before the court of law anytime by the aggrieved taxpayers or their business community. Now, coming to certain zero rating and exemptions, zero rating has been proposed to be extended to suppliers of raw material as well as locally manufactured plant and machinery to businesses set up in the Gawad free zone. However, to avoid the misuse, it has been stated that if the goods are supplied back to the tariff area in Pakistan, the tax will be charged at original cost or import value. You see, this is not allowed that you supply to the Gawad or to the zones, economic zones, at, for example, 100 million, and you then buy back and bring back to Pakistan at 50 million or a reduced value. If this happens, tax will be basically remain payable at 100 million. That's the original import value into the Gawad zone. Then import and supply of ships that has been extended to 2023. That was expiring this year. Import and supply of diabetic food intended for consumption of children that is supposed to be exempted from sales tax. Then there is a revision of concession and fixed tax, and under the 8th and 9th schedule, potassium chloride, the rate has been enhanced. For tier 1 retailers of textile and leather finished articles who have integrated their POS with FBR, the rate has been reduced from 14 to 12%. You see, there the, the general perception is that all type of tier 1 retailers are required to be registered with the FBR, and they will all those uh, integrating their systems with the FBR system will basically be offered the reduced rate. This is a wrong perception, because the law very clearly says that only this particular sort of an exemption or concession is available only to the retailers of textile and leather goods, and not to every other retailer. But if we just do the simple mathematics, if the with 17% input tax and output tax of 12%, I understand that all these retailers are likely to end up in refund position. So that will be very difficult for the government to honor, because the scheme of 5% cashback to customers that was previously announced in the last uh, budget, and has also not seen the light of the day. So we'll have to see how this happens and how the things move with the retailers who have integrated the systems with that of IPR. Another good step last year, uh, VAT payment at import stage was linked to customs duty applicable on import stage. Any importer of goods attracting customs duty at the rate of higher than 16% was required to pay VAT. Now, what has been done is, apart from various concessions on the customs side, the proposed amendment restores exemption of VAT import stage for manufacturers. So you see, if you are importing raw material and semi-finished goods for manufacturing for industrial purposes, it will not be exposed to value-added tax at import stage. That is a good step. These are various provisions in the excise law. Uh, the first six that are before you, there are identical amendments that were made, and we discussed them in the sales tax law as well. There are a couple of them are new. We'll discuss this. Uh, there was a provision there a long time back in all the fiscal laws, that tax audit or the duty audit will only be conducted once in 3 years. Now, in you see in the Finance Act 2019, in the sales tax and the income tax side, these type of amendments, these type of benefits, I would say, were withdrawn. However, in the excise law, it was kept intact. Now, this scheme has also been done in FED as well. The question arises at this point of time is whether audit of both years during which such provision was on the statute book could be conducted after omission of said provision. This is whether the audit will be conducted or not. This will have to be seen, and this will remain a dispute, in my opinion. Powers to confiscate dutiable goods, yes. Previously, the scope of confiscation was restricted to cigarettes and manufactured tobacco and beverages. Now it is exposed to every dutiable item. All excisable items will be exposed to confiscation if duty is not paid. But we believe that field formations may face challenges and practical challenges before they implement the law. Uh, Appeals to tribunal, yes, again, in reference of section 131 and 132 of the income tax ordinance that has been inserted in the FED Act as well, and according to which payment of 10% of tax demand is incorporated in provision of income tax ordinance will also be applicable for FED. As rightly said by Haider, these are basically these steps which are hurdles and obstacles in dispensation of justice, and uh, principally this should be done. All these amendments should not be part of the statute book. Duty structures have been changed on cigars, cigarettes, tobacco, that has been enhanced from 65% to 100% of retail price. Filter rod for cigarettes, that has been increased from 75 paisa to rupees 1 per filter rod. However, there is a marginal difference or reduction on the cement side, whereby FET has been reduced to 1.75 per kilogram from 2 rupees. They're sensing that energy drinks and e-liquids and e-cigarettes, they are in high demand. So therefore, uh, excise duty has been imposed on caffeinated energy drinks at the rate of 25% of the retail price, whereby e-cigarette kits will be exposed to rupees 10. Imported and locally manufactured double cabin pickup vehicle will basically attract FED at 25% in the case of imported, and in the case of local 77.5% ad valorem. So this basically brings my presentation to an end. I hope that I have uh, been fair to the time allotted to me, and I thank you all for bearing with me.
Thank you very much, sir. It was very insightful, and we will carry on with these discussions in upcoming panel discussion. And we have to move into the panel discussion right away. We are a little running out of time, so we might have to extend this session to 6:15. So please stay with us till then. So the title of our panel discussion is Amendments Introduced to the Finance Act 2020. It's going to be a 40 minutes discussion. We have with us today Mr. Ibrahim Kasumbi, who is a director and former SVP, Umair Petrochemicals and Karachi Chamber of Commerce and Industry. Welcome to the panel, sir. Thank you. There you are. And Mr. Zeeshan Shahid, who is a partner at Deloitte, Yousaf, Adil. Welcome both, sir. Mr. Adil Patel, thank you again, sir. Mr. Adnan Mufti, and our very own Mr. Omer Zaheer Meer, FCCA. He's chairman, member network panel, ACCA Pakistan, and he's a managing director at MLCC. Omer Zaheer, we have 20 minutes for the question and answers after the panel discussion. So over to you.
Thank you, Hina. Can I request all the participants to mute themselves as there is some background noise, and then the panelist answering the question can unmute themselves. Okay, let's continue. First of all, thank you very much, Haider Saab and Mufti Saab, for the informative and detailed presentations. I'm sure our participants will elaborate further on this topic. Most of us have already been introduced by Hina. I'll just quickly introduce Ibrahim Saab and Zeeshan Saab before starting the panel discussion. So Ibrahim Kasumbi Saab is a director and ex-SVP at Umair Petrochemical as well as Karachi Chamber of Commerce and Industry. And Zeeshan Shahid, our dear friend, the evergreen and ever young-looking partner from Deloitte, Yousaf, Adil. We already know about Haider Ali Patel Saab, who is the senior partner for taxation at EY, and Adnan Mufti Saab, the partner for indirect taxation services at Moore, Shekha, and Mufti. Lastly, as Hina has shared with you, I'm an ACCA member, a fellow chartered certified accountant, something I take pride in. I'm also honored to be the chair of MNP and Taxation Committee of ACCA. ACCA held its first post-budget seminar on the last Saturday, immediately after the budget announcements were made and the budget speech was delivered the day before in the National Assembly. ACCA was honored to be the first professional body in Pakistan to hold that discussion. And today is the next in the series of the session, and we'll be holding even more sessions. You might want to refer to the recordings of these sessions. We had the entire panel based on ACCA's on-member and taxation subcommittee in the previous session. This time we had members from a diverse background, including the corporate sector, to take everyone's view. Now with this, let's quickly start with the first question. And I would like to place this question one by one to all our dignitaries all our esteemed panelists. And I would request you for this initial question, if you could be very brief and just give your perspective in a couple of lines. So the first question to set the scene is, how do you view the budget 2020 overall in view of the ongoing pandemic and global recessionary pressures? What's your overall view? I would like to start with Mr. Ibrahim. So, sir, if you could unmute your mic and give your view.
Thank you, Zeeshan, for being the wrong way. Thank you very much, everyone. Not so much in terms of what we have and we are unfortunately, the budget review has including the Aslam growth report, which is growing entire domestic economy. We also focus heavily on exports growth, whether it is the refinancing packages that were given or the I think I will not in greater detail if you will allow me later on. But overall, the feedback that we are getting from the markets, from the savings that we have about development, generally we don't see those bold measures that ought to be taken, which I can term as fact-finding. Because versus last quarter, we have lost some of the many lockdowns and affected the downstream, including the sales from the SMEs, great deal more than it has affected last year. Eventually, it's going to affect everyone. So, if you would allow me later in the discussion, I will come back to the specifics that we have looked and what we expect now.
Thank you, Ibrahim.
Umar, we can't hear
please
you,
mute
Umar.
yourself?
Sorry?
Could you please mute yourself?
Yeah.
Thank you. It got unmuted again. Thank you. Okay, now the same question to you, Zeeshan bhai. What's your overall view on the budget 2020?
Thank you, Umar. Thank you, ACCA, for inviting me. My overall view is that while the finance bill addresses a lot of procedural improvements that are very much required, they were regardless required than the pandemic and the recessionary situation that we are in. Right now, the budget seem to have addressed to some extent the healthcare emergency needs of the current situation, but it is lacking right now in terms of the stimulus it was probably required to introduce in the market, considering the lockdown and the various segments of the society that are suffering. I think with the introduction of the anomaly committee and the other recommendations that are continuing to be pouring in, there may be and there should be some recommendations to support a lot of different sectors, particularly the SME sector and the notoriously infamous the undocumented sector, because they are the worst hit by the lockdown for the last quarter. And there needs to be some sort of support in terms of taxation relief or some sort of incentive. So right now the budget does not answer that question. We had couple of things that were threatening us. We had COVID situation, we had local situation threatening the agriculture, and we have this economic downturn due to the lack of activity. So we saw some increase in the health budget, but at the cost of the education budget. If you might have heard the HEC chairman just saying that we are digging our own grave. So there is a lot of balancing act. Right now, the budget needs to do immediate changes to address the affected sector in order to be really seen as something other than an arithmetical exercise.
Great. Thank you. Onward to Haider Saab. Could you please share your perspective on the overall budget?
I think we are really in a difficult situation. I think unprecedentedly. I think because of COVID, not only us, but I think major economies of the world are in trouble, and everybody is trying to find ways and means to how to overcome the economic crisis. I think we were already under crisis before COVID came and hit us. So let's number one, let's admit that it's a very difficult situation for the government, and let's keep in mind that this government has come to power for the first time. It has no past experience also, but nevertheless it has gathered from all around. I would say people who have had experience in the past. The finance minister is also very experienced, and but then we are under the IMF program, and as I have seen how things are operating on the taxation side, you don't have much room for I would say adventurism. I would say that as people were expecting that salary rates would be cut down, or the corporate tax rates they should go down, or there should be some drastic exemptions to certain sectors who have been badly hit. So, but there's hardly any fiscal room, as you see, because our tax collection where it stands vis-a-vis our old situation, our debt servicing and everything. So it's a very thin string, on which you are running. So can't we should not be building our expectations too much, but then still, we were expecting at least some measures apart from the SARS program, which the government launched, and it has uh, drawn out a very large sum out of that, and handed over to the poor people. But
Yep.
except for that, even on the health side, except for duty cuts and zero rates and things like that, we are yet to see very drastic measures. But these are extraordinary times, and I think at least I was not expecting something very big from the government side, because we know that even if you ask for an exemption today in income tax under the second schedule, keep this in mind that it has to go and be I would say signed off by the IMF panel.
So basically,
This
to
is
sum
the
up, you
reality
are
of
saying it's like a wartime budget, sans
yeah
the political popularism. Okay,
yeah.
great. So next on to you, Adnan Sab. Considering that post 18 amendments, many things have been given to the provinces. I keep on hearing about health and education, even from professionals otherwise, and I have to share with them that post 18 amendment, this is the provincial purview. The example is quite like you take a Punjab or Sindh's budget and say, well, there has been no allocation for defense, so it means Pakistan is not spending on defense. Not at all. That's a federal subject. So basically, the allocations for health and education in the federal budget are majorly symbolic. We can say that, yes, for the federal territory, that is still within the federal purview, but otherwise it has been devolved. So, keeping the feedback from all our other respected panelists, to sum up the discussion on this question, what are your views? How has this wartime budget been like for you? I'm referring to the pandemic as the war, not the real war.
Well, I will basically second what has been stated by the other learned panelists, especially Heather. We didn't have much room available. We have strings attached under the bilateral uh, donor programs, especially the IMF. Uh, Last year as well, we had a very ambitious sort of a revenue target that was not achieved by the government, and especially this corona came up. So basically, no one can basically actually predict the future. But keeping aside what this pandemic is basically going, going along, you see, on the arithmetical side, if we look at the capability of the government machinery and the economic, you see, environment, uh, and the target, and with an enhanced target of 27%, I don't know from where the government is going to get all these funds, and maybe we will be having some sort of a mini
That was
budget or some.
that was actually a question to be directed at you. So since you have already touched that, I'll have to strike that off now.
You see, this is a very very complicated situation, because they say that they have not come up with a new tax, any new no new tax has been introduced. They have tried in their way and their limitation within their limitations. They have tried to come up with some sort of a concession, you see, and sort of an amicable environment. They've reduced the customs duties. They've so you see, the revenue side is quite fragile at the moment. I don't
Yep.
know how they are going to make the figures work out at the end.
Great. Thank you for your feedback. Over to Ibrahim Saab. Sir, can you speak now so we can test your mic before going ahead?
Can you hear me? I have tried to reset the mic.
It's much better now. You are audible, though there is still distortion.
I will try and react to this as much as I can because I do not have a recording.
The distortion suddenly went up, and you are not very audible again.
How is it?
Rashid, is it possible to get Ibrahim Saab on the phone so we won't have the voice issue?
I guess that is better.
Oh, you are much audible now. Can we ask you the next question about the budget? Basically, if you look at the budget, it seems like there are kind of two experts making the same budget. One from the taxation side, and Patel Saab and Mufti Saab has referred to many shortcomings which many tax experts are pointing out. But there is also the economic side, the impact on the businesses, the sectors, the overall growth, not levying any new taxes or going for popularism. So you as a businessman and someone who has been very keen watching these developments, what is your opinion that in the current pandemic, in the current situation, where we can see the state manufacturing, agricultural, and service sector is in, what do you envision? Where would we get the growth from, or which sectors would possibly have the stimulus? Over to you, sir.
Thank you. Firstly, I would say that it would not be entirely correct to say that there is no new taxes, because in certain areas the amendments have been made to the Finance Act, provision that in the existing taxes have been increased or will be increased effectively. So it is not entirely a taxable budget. What we expected was to have a budget that has focused on domestic economy, which includes agriculture, which includes service sector, and which includes the retail sector as well. What happened unfortunately is that the two sectoral on the reduction, right? The second one is usually actually required. That's where the government lost its fiscal space. This could have been saved for the budget and largest chamber in the country has to focus more on domestic economy rather than the export. If you look at the prior to the budget, if you look at the relief packages or refinancing packages from the State Bank of Pakistan, they did not reach the lowest level of the SMEs as it should have been, because this is where we really have many I would say retailers, portion of the market, they are going through a terrible time. This is where we get some microfinance MSMEs. But when you look back at the package of 96 billion rupees, which were announced and within no time was disbursed by the State Bank of Pakistan, it went to 1,322. Just 1 3 And when we look at our numbers, we said that there are hardly come by somebody when people competition and the grocery shop, the corner shop, those people who are really in trouble because of the lockdown in the last 5 months. Really need that So what we saw is the 96 billion rupees. They were sitting strapped with a high the borrowing paper at a higher rate of 12% or something, and they simply strapped with a 4% loan. So unfortunately, absolutely where it was intended. Now, what we have proposed to the government is to provide across the board within BC. Exports are about 8% of the total, and 92% is the domestic. Whether it's large-scale agriculture or manufacturing, retailers, everyone, and importers. So that is where the resources lie. And then service sectors and startups. But unfortunately, there was not much overlap in the discussion with the government when they tried to manage things. Where among the advisors also was not that positive, and a large part of the system, the bill contains the amendment in the provisional administrative income tax ordinance, income tax act. This is where all the contributions for administration power to be provided. 45,000 or 45,000 people are being covered. So where do we step?
Ibrahim sir, I have called on your cell phone. Could you please pick up so I can put you on my mic and you'll be much more clear because it's very hard to hear you. If you could mute your mic, it would be clear. Perfect. Sir, can you continue, please?
Sorry for that trouble. Okay. So now what I was saying is that I don't know how much of it that you were able to hear, but what I was trying to say is that domestic economy was where the relief was much needed. And down the road in the next year or two, with the global economy in such crisis and how much it will recover, we will lose export orders. And we have to help the domestic economy. That includes all sectors. That's manufacturing or retail or wholesale or importers to survive this period. If they will survive and stay alive, they will be able to contribute in the future. So this was the time where what we needed was a firefighting kind of budget that would provide relief to the domestic economy rather than just being export focused. I don't know if you heard me about the refinancing package that was disbursed by the State Bank of Pakistan. 96 billion rupees were disbursed in no time, and they were simply swapped with the high price loans or higher interest loans by the cheaper loans. But the sectors that really needed the help in this crisis were the corner shop, were the retailers, were the SME, small industry. They are all going through a very tough time. And many of them will go bankrupt and close down. Coming to the Sales Tax Act that our learned professionals discussed today, Haider Saab and Adnan Saab. So we do not need the provisions like GNIC because in the present budget the provisions are that the FPR has acquired powers to access to database of all kinds. That is FIA or immigration or banks or electric, any, you name it. Under that circumstances, they should now take the responsibility to broaden the tax base. What they are doing is the onus is on taxpayers.
Sir, this is a follow-up question. I'll be asking this question. This is exactly the question we'll be asking to our panelists because a lot of people want your expert opinion on that. But thank you very much. I'll move on to the next question now. But please stay on phone with me. I'll mute the mic. And when I'll come back to you again, I'll unmute. And then this way we can hear you clearly. I'll leave this call on. Okay, that was Ibrahim Saab. Thank you very much for your expert opinion. Now onward to Zeeshan. Zeeshan, the total outlay for the next fiscal year has been projected at 7,132 billion, whereas the total revenue is estimated at 6,573 billion, with FPR share projected at 4,963 billion, as opposed to the 3,900 billion for this year. So it's more than 1,000 billion for this year's target. And we know that pandemic, as per expectation, is not going anywhere anytime soon. So in this situation, with the ongoing economic crisis and pandemic, do you believe this target is achievable? If so, from where and how? You need to unmute yourself, Zeeshan.
I think the answer to this is evident in the past history that we have seen. I think in the past year, we started off with a target of 5.5 trillion and which was revised twice even before Corona or COVID-19 effect started. And I think the government narrative, obviously, all the governments have a different point of view. They don't really highlight what the weaknesses in the system are. But their point of view has been that in the current fact that they are damaging. There has been a damaging effect of COVID-19 on the collection and everything. But even before COVID-19, the FBR was facing collection challenges. In the last quarter, traditionally in all the years, FBR does face collection challenges, and this time the last quarter was also exacerbated by the COVID-19 effect. But even then, if you see the history, it has been fairly consistent of what the amount of taxes FBR has been able to collect. I'm not sure, and as the esteemed keynote speakers have also pointed out, that the collection, the enforcement mechanisms, there's not much groundbreaking new innovation that has been introduced over there. And the linkages of databases, Adnan Mufti Saab rightly pointed out, this is hardly a new innovation. If you recall, there was a FBR chairman who was practically sacked by the government at that time. He also introduced a system inside we were supposed to link all these databases and really give a profile of the taxpayer. So I believe there will be during this year there because this is a year where domestic, international, all experts have said that this will be a good recession. But with Pakistan, they're hopeful. They're saying that by 2022, Pakistan will bounce back. And but the collection is going to be challenged. This ambitious target is going to be revised. I hope that they do something that now that the FBR is led by a career bureaucrat, very and there are hopes that she will be able to run the organization how the organization intends to be run. And there are a lot of reform efforts that are going on within FBR. I'm sure Haider Saab and Adnan Saab are much more aware of the reform efforts. So if those reform efforts do bear fruit and increase collection, then we have some hope. Otherwise, I believe the targets will be revised down.
Okay, great. I'll just quickly add something that we had in our last session on the post budget. You have said some very right things, and they are very pertinent professional observations, Zeeshan. However, we also need to look the thing in context. We have less than 22 lakh filers, of which almost half declare no income. So they want to buy a property, whatever the reason, they get the NTN. We are all aware that the business taxes is much higher. I don't go for the argument that people don't pay their taxes because they are indirect taxes, and practically we are paying taxes on everything. But with regard to direct taxes and proportionate share of tax, perhaps not. So what was referred to in our discussions earlier, and which you also gave a hint of, the measures to broaden the tax base, that can be the sole answer. If that can be achieved, then there might be a hope of achieving the target. Anyway, that was a very good answer. Thank you. We'll move on to the next one. And this is for you, Patel Saab. Are you ready? And it's quite a big one. It might put you in a difficult situation because the question is very challenging. Not challenging technically, but challenging in terms of your relationship with the people that it might impact. Anyway, the question is this, that we do appreciate that this is a pandemic. I sit on the Global Tax Forum as well as the editorial board of MESA Region, Policy Insight, etc. And I've seen the global budgets. And I can say there is always room for improvement. But just like you also said, considering the situation we are in, it's much better than many in the world. Having said that, on the taxation side, we already know that one prime reason why people don't come within the tax ambit is the lack of trust. And one of the prime reasons for that is the actual or perceived harassment, which culminates from the subjective powers. and some of the measures that have been discussed, such as the CNIC requirement, despite having the database, just like Ibrahim Saab was referring to, the proposal for submitting 10% of any frivolous tax demand if you lose the appeal at Commissioner Appeal Forum, which practically is not independent because Commissioner Appeal is coming from the FPR, the requirement to do away with the definitive information in case of audits, etc., etc. So these reforms on the taxation side, which seems to exacerbate the problem, and that too in a period when we are focusing on broadening the tax base. What do you see the impact, and would you propose that such measures should not be the part and considered as anomalies and withdrawn from the Finance Act to be enacted? Over to you, sir.
Yeah, I think you've put it very well that, if you bring in more and more regressive provisions in the law to tie down, suspected taxpayers who you feel that, they're not paying their due taxes, I think it has more repercussions on people who are sitting outside the fence. Because the way the audit is working within the FBR, everybody knows, and it's not something that I should be mincing words on, that audit is not at all effective. It's not an effective measure. If you pick up the collection, our collection is now beyond 90% to voluntary taxes and in withholding taxes and advance and things like that. Taxes don't come out of audit. All the audit has done so far in the last, I would say, whatever, almost 20 years we are now with the new ordinance, that it has kept on shaking the confidence of the taxpayers. That you keep on getting notices where there's nothing new in those notices. We have yet to come out of the 1979 framework of mind. We're still on the colonial side of it, that what I write in my order, that has to be followed. And they are not, I would say, we have been propagating from various forums, from ICAP, from methodologies for different based on different sectors. There are studies on these, and I would say that Institute of Chartered Accountants once prepared actually for them for FBR sector-wise audit programs, and this was actually done about a few. I was part of that committee, and we for
Okay, I think Haider Saab's connection is reconnecting, so we'll have him soon. Welcome back, Mufti Saab. Good to have you back. I hope you pray for us all and the country too. You need to unmute.
Yes, am I audible now?
Perfectly fine, sir. Great. I have a quick question for you, Mufti Saab. In your presentation, you referred to the requirement about the CNIC and the proportionate disallowance of the expenses. While you were away, Ibrahim Saab made a reference to this, and he asked, why should the taxpayer be penalized for the lack of work on FPR's part? How do you think this would impact the local businesses, the SMEs, particularly when the pandemic is going on? We do appreciate the need for broadening the tax base and level playing field, but FPR has already proposed access to all the databases. So in lieu of having that access, what was the need to introduce this? And now that it has been introduced, in your opinion, how would this impact the businesses, particularly the local SME sector?
You see, we have been talking about expansion of tax base. The FBR talks about it a lot. The government says, the business community says. But you see, what the FBR basically fails to understand, and the government at large fails to understand, that it is not the job of the taxpayer to basically collect taxes. The first thing that basically underwent in this direction was the introduction of the withholding tax. By starting this withholding, and then withholding also saw it kept changing. It kept changing. Kept you see faces were changed. The modalities were kept changing. So you see now the FBR has, and it was not in it was a public information. The then finance minister few years back, he publicly admitted that people do not trust the tax machinery, and therefore at that particular time the government came up with an idea, and it is still on the statute book, that sales tax is collected by utility companies, by gas and electricity distribution companies, because the finance minister at that point of time admitted that people do not trust the FBR. So basically, it is, I completely agree with my learned colleague that it is not the job of the taxpayers and the businesses to basically start collecting CNICs, the databases of the unregistered sector, to make them compliant, to bring them on the tax roll. It is basically the government arm must basically be so efficient to do all this. So this will basically hamper the business activities, already fragile activities, and it will not bring anything. And I've already said, and I am privy some of the details. There could be litigation on this front. This is not going to go well within the business community.
Agreed. Thank you very much for that elaborative answer. We have a lot of questions from the participants for our esteemed panelists. I'll ask one last question from Ibrahim Saab before I open the session for the online questions we have been receiving from our participants. So Ibrahim Saab, in this budget, the estimate is that approximately 40% plus of the budget will be spent on debt servicing. Now, we are aware that the government has done some key reforms which were needed, especially for the currency, making some liberal reforms, letting the market decide the rate, with the hopes that it would translate in increased exports and a better sustainable economic model for the country. However, we are aware in this pandemic, there is only so much you can expect in terms of export growth. So don't you think that at least perhaps for the short term, it is time to revise the priorities, and just like you were referring to, focus on giving some space to the SME? If so, what should be done with regard to our forex policy? Because any further shift in that might cost dearly in terms of the national exchequer paying the foreign debt, as well as the raw materials, etc., that the SMEs might need to use and might not even translate in much exports during these times. So what's your opinion on that, sir? Sir, you need to unmute, I think. Just 1 second. It's fine. You are audible now.
Okay.
Can you mute your computer? It's fine now.
Okay.
Thank you.
There's a lot of noise behind. Can you hear me now?
Perfectly fine, sir. You are audible now. Please continue.
Okay, great. Two or three things that you mentioned, and first of all, this debt stock that we have, 80% is about domestic debt.
Mm-hmm.
So here we can have some deferral for the time being, considering the circumstances that we are in. At the same time, if we look at the exchange rate, the dollar is around 166, 167. So on imports, whatever revenues, a major part of revenues are collected on imports, and about 45%. So automatically, the revenues will increase with the, of course, imports have gone down, but still it will be made up by the devaluation.
Mm-hmm.
And then again, in the perspective of this pandemic, and to support the SMEs, we will have to take some extraordinary steps.
Mm-hmm.
Our already government has got the deferral from the Paris Club. It has got some relief from the lenders like G20 and even IMF.
Yep.
So they have got some space there. They did not need to reduce the petroleum price second time around. Again, they may have saved 100 or 200 billion rupees. So it's just a question of managing the crisis. And debt servicing, yes, this has been a chronic issue. And what the government says is that they have depended less and less on domestic borrowing, and they will curtail the expenditure. So there are spaces where they can. There are innovative thoughts that they can use those areas where they can save on this losses and also defer the loans that they will have to pay. But they have to focus on agriculture and on SMEs, because which is a bulk of the GDP that they contribute. And there these resources have to be diverted. Coming to the sales tax, see, our proposal was, if you want to give an across-the-board relief, these are the indirect taxes, these are the areas. Sales tax is the main. Now, from 17% to 15%, 17% to the 15% wouldn't do a lot of damage. Yes, they will need a space of 200 billion rupees. Dr. Ahmed Atiq servers said today in the papers which I have seen. And what he mentioned again was the number of people who have the industrial connection and commercial connection. There is about 300,000 something. And out of that, only 45,000 are in sales tax registered.
Yep.
So this is admission of failure. End of the day, come whatever you do, whatever changes you make in the provisions, try and squeeze the same set of taxpayers. End of the day, you have to broaden the taxpayer. And the failure is admitted on the part of FDR. Nothing will work really, whatever they do. Well, they have the access to they have everything else at their hand. Now what they are doing is I'm going back again and again to the same issue, that is the CNIC. No, they want us to provide CNIC for the unregistered person, but at the same time they are charging 3% of penal tax, that is called further tax.
Yeah. So don't worry, that would be, I can assure you that on behalf of the professionals, this would not sustain. If the government let it go through in the Finance Act, I'm almost certain that it will be challenged in courts, and I'm sure Patel Saab and Mufti Saab would also.
I hope so too, because you can't do both. If I'm providing you the CNIC, that should be good enough. Because there was a time when they used to say that, okay, we'll convert CNIC into the GN or tax number.
Yeah.
Why not? And if you have the data, if you have the name and address of the person, you trace that. And my responsibility is over. So I do not want to pay 3%. What happens is that I issue an invoice, a fake invoice or flying invoice to a person who gets the adjustment. And we share the cost. That is, I reduce my cost from 3% to 1% or 2% and pass on that to the person who will, to the registered person who will take the adjustment and who will also, if it is an exporter, will take the refund.
Very well pointed out.
There are leakages. These have to be plugged.
True.
These have to be plugged. And I think both of our panelists in their presentation, professionals did not mention about the withdrawal of exemption on large import houses. We had it for a very, very long time. We had been recommending to withdraw the exemption. It wasn't required. These are the areas that have to be plugged. You have to do away with certain exemptions. Then you have to burden the taxpayers, especially the sales tax. It is going to be the mainstream of revenue in the future, in the near future. And if they do not, and for the 50 years they have been trying different ways of squeezing the same set of taxes, then you come back to reforms.
Great.
Both administrative and the jurisprudence, the entire jurisprudence of tax regime. So
Great.
We have a trust between the taxpayer and tax collector, and we have confidence it should be as easy as paying a utility bill like gas, electricity, and the sales tax return or the income tax return should be as easy to file as a utility bill.
Absolutely right. We'll continue this discussion, Ibrahim Saab, with the questions of our online participants, because we have a lot of questions waiting for you all. The hardest part of the job of any moderator is when he has a very, very learned panel and he just want to continue to listen, but because of time, he has to request them to stop. So I would like to, before going ahead, thank once again all our esteemed panelists, Ibrahim Saab, Patel Saab, Adnan Saab, Zeeshan, all very learned and giving very thought-provoking answers. Before opening up this session for the online questions, and that's a shout out to you, Hina, I would just like to briefly sum up in a minute or two the crux of our discussion. So, our panelists and even otherwise the professional feedback we have been receiving from not just ACCA's taxation committee and professionals, but other professional bodies, our partners institutions, tax bars and chambers, is that in terms of a wartime budget, the economic direction has largely been correct. However, the taxation reforms leave much to be desired. The regressive measures introduced would only serve to lessen the confidence of not just the existing taxpayer, but people outside the tax net who the government and the FPR want to bring it. So perhaps it is time to have some reflection on that front, and there are some areas which can be improved, particularly in terms of giving stimulus to the SME. We had some important other questions to be discussed, but since we'll be having more series of these sessions, such as the impact on various sectors for the property construction industry, the reforms in this introduced in this budget, as well as the previous construction industry package, etc., etc. Questions like these. So we'll leave them for the future sessions and now move straight ahead to the questions that we have online. Okay, so Hina, would you be putting the questions to me, or okay? So I'll be taking up the live questions we have and putting them up to our panelists. So first of all, a question that has been put to us is that about the lack of harmonization in provincial and federal budgets. So the question, and I would like to put that question to you, Adnan Saab, being focused on the indirect taxes. The definition of the taxable activity in each province in terms of origination and termination of services is a big complication for the taxpayer, especially those who are conducting their business on a national level. So we are often challenged that which province we should deposit our tax with. Still no action taken by the provincial or federal governments. Any update on what is happening?
Well, this is a big problem across the country. What information I have is that this particular problem was taken to Lahore High Court some time back, and the Lahore High Court directed the Ministry of Inter-Provincial Coordination, that is IPC, to basically call all the provincial boards and the FBR and the stakeholders to argue, to debate what's going on, and to come up with something tangible. Uh, Incidentally, I was also part of that meeting which held the IPC. But I'm well, you see, it was a regretful event that the provinces kept arguing with each other and basically could not come up with any tangible solution. They kept insisting on they kept stagnant with the respective positions. Since, for example, was on one side and all the other provinces were on the other side. They were demanding tax on the basis of termination, and Sindh was demanding on the basis of origin. So basically, the matter what little I have with me has been referred or was about to be referred to the Council of Common Interest, that is CCI, that will basically decide all this. What, but as a professional, what I think is that until and unless FBR basically intervenes, that is the government, federal government intervenes, and it calls all the provincial bodies and the provincial boards on a common table, uh, it, it will not be solved, and it will be solved when there will be a give and take. For example, some of the taxes. For example, there is an overlapping tax in the case of franchise. There is overlapping situation in the case of restaurants on toll manufacturing. So there will be a give and take unless and until the federal government and the provincial boards are ready to basically agree on that give and take solution. This will not happen. So I'm afraid there is no concrete solution to this. Yes, the aggrieved taxpayer, if the quantum of the problem is huge, what the taxpayer or the aggrieved business can do is they can go to the provincial high court and get a stay order in
Yep.
that particular way. So basically, in that, it is likely that the high court will basically decide or basically direct the tax to be deposited to any of the agencies, whether it be a federal or a provincial authority, and so that the taxpayer will be saved from double taxation on this account.
Very well said. The next question is for you, Zeeshan. Actually, there are two questions that I'm clubbing together. The one question says the confusion over federal and provincial areas is not clear. So, does this mean that the provinces are now responsible for health and education? One. And the other question is actually, it's more of a comment, but asking your comment on this. It says that health budget increased at the cost of education. This might be because the government is thinking that education sector will remain closed for another 4 to 6 months. What do you think?
Okay, I'll try to answer that sequentially. Uh, After the 18th Amendment, obviously the health budget is now the responsibility of the provincial governments. And it is said that now, after the 18th Amendment, education is the provincial matter, but it had been even before that, education was under the provincial ambit. And these things are not vague, not uncertain. These are pretty much decided. There's a list in the constitution that tells that what areas are provincial and what areas are under the federal list. But in this budget, if you recall, the size of allocation to all the provinces has reduced because the size of the overall budget has reduced. This will invariably have effect on each province's ability to allocate funds towards the health. On the federal level, education has historically suffered. Although, if you see just this year's budget in isolation, they have increased marginally the allocation to Higher Education Commission, but it was after a previous reduction. So they have not really restored to the old level. And I referred to the comments of the HEC chairman, Mr. Banori Saab, Dr. Banori, that he's comparing this recent emphasis towards digging our own grave, the nation's grave. And I do not disagree with him. I've worked closely with the education sector, and I believe that it will be very immature to say that the schools are closed and the budget is not needed, because majority, the significant chunk of the budget is the teachers' salaries, which has to be paid in any case. And the other thing is, you have to think about the alternative learning pathways. Now they have gained more acceptance. They require budget. There has to be research on different avenues of reaching the students. Now it's not a question of access to education in the rural sector. Now the access of education is a challenge for the urban sector as well. So these are pretty big questions to answer, and these have not been really a priority in the current budget. So yes, we have sort of prioritized some segments. I would not say necessarily health, but at the very dangerous cost of education.
Great. We have your views. Thank you. Next one is for you, Haider Sab, and it's specifically addressed to you. In fact, there are two questions. Since they deal with the same section but different areas, I'll club them together. The first one is referring to FTO's decision for 153. It's referring to the minimum taxation, the judgment of FTO in which penal action was taken against some FPR officials too. I hope you are recalling what I'm referring to. Yeah, great. Okay, so the first question is that FPR is now introducing more minimum taxes and turnover taxes. Do you think this would be struck down like the FTO did in the case of Section 153, and along with this, another question, slightly different but same section, uh, including the toll manufacturing in the definition of goods under Section 153. Is this an attempt to make FBR's case strong? Any other implications? What's your perspective? So you've got quite interesting questions, but we can't hear you. Have you unmuted yourself?
Yeah, can you hear me now?
Loud and clear. Perfect. Please
Okay.
carry on.
I think I'll answer the second part first, which is the toll manufacturing question, and which is, I think, a painful question, I would say. It's been through courts so many times. I see Adnan Mufti Sahab smiling after listening to my comment. And this is getting to and fro.
Actually,
And I think what they've
all of us are smiling on your comment.
so what they've tried to do is, I think they've tried to substantiate their claim now on the income tax side, because they have been fighting this case out on the sales tax side versus the provinces. I think this was something which was agreed that this will be sorted out between the province and the federal government. But since last year, we are seeing that the federal government is now trying to fortify its position by amending laws and things like that. But Adnan Saab will, I think, put more light to it. But I think there are still cases in the courts which are pending on this matter on the sales tax side, and ultimately things will be sorted out over there. So calling it a goods in income tax, I think, will not sort out the matter, because so there are two types of tolls happening in this country. One toll is a straight where I say that it's a supply of good, where the goods are actually, the raw material is imported by the toll manufacturer, and then he supplies the finished goods. Now that's not purely toll manufacturing, that I would see. That's like a import and then supply to the end supplier, I would say. But the pure toll manufacturing is where the principal gives you the material and the conversion material and everything as well, and then you just convert the goods into finished form and you charge for the service. So if that's the toll we are talking about, then certainly calling it a goods and asking you to withhold tax under 183(1)(a), I think it will alone, this will not like help out the FBR's case. And ultimately this has to be sorted out at the court level, because I think now the body language of FBR is very clear that it is not ready to settle it with the provinces through a dialogue, which is very unfortunate actually, because I don't think it's a bigger stake, because the province has to see it from a 30,000 feet level, that they are the central owners, they are running the NFC. So whatever taxes collected by the provinces, they are all accounted for when you finally settle the NFC. So it's just a matter of who collects what at the first stage. So, and same thing is happening in the case of restaurants. There's still a lot of debate whether restaurants are supplying goods or they are rendering services, and this is also going in courts. People are getting notices from both sides. So I think the federal government has to play the role of the big brother, I think, and they have to take steps to resolve issues, because if I can assure you that the language that I have seen with provinces, especially even with Sindh, that if federal government decides one thing, by sacrificing, I would say something, although it's not a sacrifice, it would be something to go in the right direction.
It's all about the revenue at the end of the day.
Yeah, things will sort it out. But at the moment, yes, my answer would be that this amendment will not help out resolve this issue. This is just an attempt to fortify the position.
Okay.
I can't recall the 153. It could be a specific issue, but you see, we have to understand that the broadening of minimum tax regime is a step down from the final tax regime. We all understand that there are we are running on a very tight string, and the government can't afford a deep dive into the revenue. If you remember 3 or 4 years back, when they introduced for the first time the minimum tax, they gave a percentage that if your tax works out to 60 or 70% of the minimum tax, you can still go there. But then what happened was huge refunds started piling again, And then the capacity issue comes in again, that FBR, because it's not developing its capacity by introducing more and more automation, they don't have the capacity to examine all those returns objectively. So that's why, and then coupled with the element of corruption down at the root level, these refunds then generate a lot of corruption. So they receded on that attempt when went back and said, okay, now the minimum tax will be the tax that you pay at the import stage or whatever. So the minimum tax is it really is a step from coming down from the final tax regime, and then it has to go back to actually the real taxation. As I read in my paper that the final taxation statement has been withdrawn, and now they are saying everybody will file a return. So these are all baby steps towards achieving the final goal. But I call it baby steps here. But then there will be a big leap if you allow people. Like this year, they have said that the industrial undertakings on the import side, the goods that fall under part 1 and 2, which is now a big debate in going on, that many of the goods have been left out and many have been put into part 3, where actually they are raw material for the industries here, and they are saying no, these are finished goods. It's a big debate. But then they have been asked to it's been categorized as adjustable tax, so that's a big step towards that.
You're right.
So
I would like to dedicate something
have
to you.
understand that point and come forward. Yes, hardships will be there, but I don't see that why this can't work out. This has to work out. Otherwise, you will never reach the point of real taxation.
Yep. It has to be said in Urdu. उसने जो भी कहा मैंने जाना गोया ये भी मेरे दिल में था. So thank you for that, giving voice to all the professionals and businessmen. I think I'll just answer the other question. It was probably not clarified. So it was referring to the FTO's judgment on section 153 with regard to the minimum taxes and etc. The judgment in that case was reached on the confession and testimony of an FPR official at that time. So there's no such thing happening at the moment. So with reference to the other question asked, I don't think that would be the route that would be taken. FTO might go into might get into the proceedings if there is a maladministration. Otherwise, the court of law would be the relevant forum. So the last question of the day, last but not the least, to our very diligent and deliberate Ibrahim Saab. Are you ready? We both need to be ready for this.
Okay, now you're ready. Okay.
Okay, so the last question of the day for you, sir. We have discussed the overall impact of the budget, some important measures, the taxation treatment, the focus on the SME sectors, etc. It has been said that no new tax has been imposed, despite the issues that the government was facing. Some good measures have been undertaken. Like you mentioned, about 1,200 billion rupees space has been approved in principle in terms of the loan repayments, which has given a breathing space to the government. However, do you think that the measures that have been taken, if you take into view the package for the construction industry, non-imposition of new taxes, yes, there are some measures which can be taken, like you have mentioned, or other panelists have shared about the reforms on the taxation side. If we leave that reform thing aside for a bit, purely in terms of an economic discussion, do you think this budget can help stimulate the economy in these challenging times? If yes, how? If not, what needs to be done?
There is more to be needed. Yes, you are right that no new taxes were imposed that would be well received by the larger economy, because generally whenever we increase any tax or indirect taxes, it goes down to the consumer level and it is passed on. So yes, in that sense, yes, it is right. But when we say that there was no new tax imposed, actually what was expected in the budget was some stimulant. In the present situation, had it been the routine normal situation and the same budget would be presented, it would be taken as a stimulant. But because of the loss of GDP in the last 3 months, because of the COVID, because of the lockdowns, we would have preferred to have some relief in some tax rates, basically in the sales tax again. So I would say it is a stimulating, it is a stimulant, or it will trigger the growth. But it may help us survive for the time being. And as one of the panelists said, that the future, is we are optimistic about it in the next 2 years. The opinion from the experts is that Pakistan has a potential. Obviously, I am also very optimistic in the area of, particularly in the area of agriculture, where we need to set priority. Instead of sugarcane, we need to grow cotton, and there we need a lot of support. That is one area where we need to really focus, because there are conglomerates which are forcing the change of priorities in the agricultural sector. We are importing cotton instead of growing it and exporting it. We used to produce 13 billion bales. Now we are producing 9 million bales. So we are running short on that. On the other hand, what we are saying is that our main export is cotton textiles. So here, if we have to import and then we export, that really is not going well for the economy. So there are priorities that have to be set. And again, the budget, if you are talking about, we need to also look at the SMEs again and try and use that particular sector for the growth area. In other countries like Korea or China or any country that has a high GDP growth rate, have initially been the driving engine has been the SMEs. And SMEs in this budget are still looking for some kind of support.
Very well said.
Neither they receive from in the budget or nor from the State Bank of Pakistan, where a very huge amount of 96 billion rupees could have been really spent judiciously or diverted very judiciously to the small scale, to the small industries, SMEs and others. So by and large, I'm not very disappointed, but there are.
But there is room for improvement.
There is a lot to be wanting.
Great. Thank you very much, Ibrahim Saab. Very learned views. Please stay online while I thank everyone and deliver the closing remarks. I would like to, first of all, thank ACCA, the entire team, Hina, Rashid, Wasil, Temur, head of our member affairs, Harun, Sajjeed, everyone on the team, our taxation committee who contributed to the questions and all, our panelists and presenters, Ibrahim Kasumbi Saab, Haider Patel Saab, Zeeshan Shahid Saab, Adnan Mufti Saab, everyone. And thanks to all the attendees, members of all the professional bodies, as well as ACCA members and people from our partner institutions who attended this session over several social media platforms, including but not limited to Facebook, Twitter, LinkedIn, etc. It was a pleasure having you here. This is one of the key sessions that we have delivered, but this series is continuing. You'll be getting updates about the future events. So stay connected and do join the future events too. Thank you once again to everyone.
Thank you.
Thank you.